Thank you, Brett, for the presentation. Next is Mr. Porter Bennett. Porter will be providing an economic analysis regarding the U.S. oil and gas markets. He is president and CEO of Denver-based Ponderosa Advisors, an advisory and information firm for the energy and water sectors. He has spent more than 30 years in the energy industry analyzing the natural gas and crude oil markets. Please welcome to the stage Porter Bennett.
Nice to meet you. Okay, cool. Thank you. It's a pleasure to be here. I was trying to remember. I think I spoke here when I was still at Bentech. I was the founder of Bentech and did all the natural gas flow and economic analysis in the 2005 to 12 timeframe. And I think the last time I was here was when I was still running that. It's a pleasure to be here. I'm going to focus on what I consider one of the big mysteries of our day. What in the hell's going on with the oil and gas markets? It's a pretty confused bunch of things is really what it boils down to. My slides, by the way, I provided a copy to the association so you can pick them up if you want, or you can just stop by and give me your card and I'll send them to you directly. There are four things that by the end of this that I hope are instilled in your minds that you think about for a while, because I think they're really the key things that you want to know. The first one is that we've changed from a world of scarcity to a world of abundance. And that has huge implications on a lot of aspects of the business, but particularly relevant today is we have too much demand relative to supply. Now, what do I mean by abundance? When I came into the business 30-some years ago, all policy, all investment decisions, everything that you thought about relative to energy was predicated on the notion that we're running out of either natural gas or oil. And the implicit statement there is the price has to go up. It becomes scarcer, the price goes up. That's all been flipped on its head over the last 10 years, and I think right now it's the opposite. We have too much, not enough, and probably we have too much for a long time. The oil is a little bit less certain in that respect, but it sure looks that way, and you'll see what I mean by the time I'm done, I hope. But the point is today, the markets are more about demand than they are supply, and that's the key that you want to walk away from with. The second is that oil and gas are no longer independent. In the 80s, 90s, up until late 90s, oil and natural gas were substitutes. You could, if you had a power plant or a big industrial facility, you could switch between the two commodities depending upon what the relevant prices were. Now, today, by the end of the 90s, certainly by the mid-2000s, that substitutability was gone, and so the world thought of the two commodities more independently. Oil companies in the 2005 timeframe did a lot to scrub natural gas, scrub oil out of their names. By 2012 or 13, they're trying to put oil back into their names because of Wall Street's influence. The point is now they're connected at the drill bit. And the economics for drilling and decisions to drill are predicated on the combined aggregated revenue coming from all commodities out of the well. So that has a lot of impact. The most important being is the third point here, that because crude prices are so low, we're not drilling as much crude, we're not drilling and producing as much associated natural gas. At this point, we're not producing enough to clear the U.S. market, which means that natural gas prices will have to rise over the next several years. So you'll see what I mean by that. And then the final point is volatility is going to affect this industry like it hasn't in my 30 years of watching it. I think one of the salient points that OPEC let loose when they changed or they implemented their policy last fall was they took a book out of the Fed or a page out of the Fed's book when they decided that if they make it sound like supply is going to go down, prices will go up. When the prices don't go up, the market falls. They'll make some more noise that they're going to take more off, and the prices will go up. And that's, that kind of activity will persist, and you'll see a lot of volatility in the crude market because fundamentally we haven't affected demand. So you'll see what I mean by that as we go through this. I'm going to start by talking about oil markets, then I'm going to talk about the natural gas market and how it relates to the oil market, and then talk about I'll present Drilling Info's natural gas and oil price projection. For those that don't know it, I sold my Ponderosa Energy business to Drilling Info, and so actually now Drilling Info is the source of the information that we produce, and I'm actually on their board and representing them. And then finally, if there's time, I've got some slides on the Northeast, but I think the pipeline guys in the previous panel kind of brought up most of those issues, so it's probably not so important. As we go through, I guess we'll have questions at the end, so let me know if you get something as we go along. Maybe we can deal with it as we go along too. Let's start with the international oil market. What you've got here is a graphic. The black line is supply, the green line is demand, and those red bars are the difference. And you can see if you go back prior to 2014 that there was more demand than there was supply on average, and the price was relatively high. Average 91, but it ranged anywhere from 69 to 120 almost. By 2014, the first quarter, you could see the two catching up with each other, and by the end of the year, we had a significant surplus where we had more supply than demand and prices started to fall. When the initial or the cutbacks early in the fourth quarter of 2014 didn't really work, you saw the surplus build and prices came down further. And then over the last year, we've been kind of hovering around balanced, but not quite. And then in the fourth quarter, we saw it pop back, the surplus pop back up to 650,000 barrels a day. So these are IEA numbers, and they're, I think they're the best things out there, but they're not all that. I think they go through a lot of revisions, let's put it that way. So you can kind of take them with a little bit of skepticism, but by and large, they're pretty good numbers. So in the fourth quarter, OPEC said, we're going to reduce supply. We've got to get this surplus. We've got to get this imbalance reduced. So they announced their cuts. So here's a table that shows the cuts and where we are. The total reduction was supposed to be 1.7, almost 1.8 million barrels a day, which, if you remember our 650,000 surplus, that's a couple times that. And then at the end of January, they'd actually gotten it down about 1.1. OPEC had done remarkably well. I think the rest of the world, Russia being the primary driver of that component of the equation, not so well. And as a result, at the end of January, we were looking at a little over 60% compliance. The end of last month, it improved a little bit, primarily because OPEC took more out. But the rest of the world hasn't really performed. That's why if you saw some of the news reports this week, the Russians were saying that we're going to be compliant fully by the end of April, and we'll see. Because right now, one of the main reasons that the OPEC numbers or the total compliance hasn't worked any better than it has is because Russia has not pulled their volumes off the market. The non-OPEC component there, just a word about that, that's mostly the natural decline of pretty much all the rest of the non-OPEC, non-Russian volumes. So we're getting some response. It's a pretty good response, particularly when you compare it to what they did in the 80s and 90s when they've tried this in the past, but it's still not that good. And one of the fundamental reasons is storage. You know, and when you think about crude and crude prices, I said we have too much demand. Well, what do I mean by that? Well, you can get a good sense for it by looking at inventories around the world. I'm using the OECD, which includes the US, Europe, and the major developed economies of Asia, Australia, New Zealand, and so forth. When you look at diesel, remember crude is used to produce diesel and gasoline, about 75% of it. The other 25 is a mix of a whole bunch of stuff. But diesel is very important, particularly in Europe. But if you look at where we are from a diesel stock, in 2016, it was a record high. When you look at the motor gas stocks, motor gas, again, record high. You look at crude, its stocks, they're at record highs. We have more crude in storage than we have ever had. You can't reduce, you can't effectively increase the price of crude until you've chewed up these stocks. When you look at the consumption rate for gasoline and diesel around the world, the last couple of months of the year it was encouraging because it bumped up a little bit, but clearly it's not bumping up enough to reduce overall stocks. So what do you have? Well, if you look at the US, this is showing you US production on the left and then our storage numbers on the right. If you look at it, and this is really what affects WTI more than the global data I showed you a minute ago, our production is higher than it was in late 2016, but it's still considerably below what it was in 2015. But yet look at our storage number. Our storage number is getting very high, 524 or 5, something like that, million barrels. That's a lot of crude. You could reduce that. I've seen monthly reductions in to the tune of about 15 million barrels, but those only have happened once or twice in the last 10 or 15 years. Mostly an average reduction is somewhere in the 2 to 4 range. So you've got a lot of extra capacity there to get it down to that 5-year average, which is the gray area at the bottom of the graph. We're almost 200 million barrels a day of crude more than we've historically operated. I was down, one of the companies, I'm on the board of an oil storage company down in Houston. We were talking, and what's not shown here is there are several tankers out in the Gulf of Mexico that are stuffed full of storage waiting to be delivered, and they're being just used as floating storage fields, and that even adds to this number. So we have a tremendous amount of crude just being stored right now that has to be consumed before you can have any kind of sustained increase in prices. When you look at why we have so much crude in storage, again, it comes back to gasoline and diesel. The gasoline's on your left, diesel's on your right. You can see our consumption levels are kind of in the near average range for gasoline. It's a little bit higher than average for diesel, but we're not really driving a major reduction in stocks. We're way above the historical numbers if you look at the average, say, from 2005 or the average from 2010. We're well above what we need to do. Those numbers, again, have to change before WTI can fall or can rise in any kind of a sustained way. Does that make sense? Everybody following? Okay. So why isn't it working? Well, shale, in a word. Shale is OPEC's nemesis. What Ponderosa Energy developed is a model that projects production as a function of the economics of areas. And so what we did is we've got this for about 350 different areas in the country. We've taken all the basins and divided them up into very small units, and each of those units we then look at as Tier 1, Tier 2, and Tier 3 production, and we drive that Tier 1, 2, and 3 production based on the performance of wells. We're using we use the end-up drilling info data, but it's all the state well data that is collected. And we've developed what we think is the break-even cost of each of these areas, and then we aggregate it up until we get enough to clear the market. And that's when we end up, that's how we end up with our forecast. When you do that, and you're doing two things. Number one, you're estimating the break-even for the basin, clearly, but number two, remember, it's a combination of the revenues collected for natural gas, liquids, and oil. So it's a comprehensive break-even across all the different commodities. This chart shows about 65 different sub-regions of the country. They're color-coded by where they are. There's 65 that are all economic at less than $60. The ones on the far left, those are ones where they produce mostly dry gas, so the oil price is irrelevant there. That's why they're essentially zero. As they move farther, the gas price, this was all done at a $3.50 Henry Hub price, and you end up building it up. And so the last ones on the right are I think that's the last one is the Williston Basin, one of the Williston Basin tiers. But that's a $60 price with $3.50 gas that comes in. There's the basis of that calculation. There's a tremendous amount of crude and natural gas that can be produced at very low prices, historically speaking. This is kind of another way of representing it. This is showing crude production, and we didn't cap it with anything except for the rig count as of about, I think we used the total number of rigs that were in operation 2 years ago. And we said, let's take and run the prices up and see how much crude comes out of the ground. Again, this is $3.50 natural gas. If it's less than 40, you can hold crude production relatively flat. Obviously, the farther from 40 you get, the more problematic it is. But when you get up into that 40 or 50, that's when you start growing it. Most of the growth in that tranche is actually between $45 and $50. When you get to the 50 and 60, you're appreciably higher. So this is one of the principal reasons why, after the OPEC announced their program in November and prices went up to $50, $55, all of a sudden new rigs came into the market. It's because there's an awful lot of what we call Tier 2 and some of the weaker Tier 1 areas that become economic at that price, and you end up bringing a lot more production into the market. Notice how sensitive it is when you get up to $60 and $70. This country can produce a lot of crude at anything above $60. This is one of the reasons why I question whether abundance, in the context I used it in my introduction, really applies to the future of the world too. Because if you take this kind of production capability and you add it to whatever else is out there around the world, you kind of go, wait a minute. How is demand going to get back above the globe's ability to produce if everything is working at $60, $70? I think it's hard to see, and I think more importantly, it's hard to see how prices get much over $70 as a long-term high, unless demand changes remarkably to the positive side. It's also important to recognize when you talk about these kinds of numbers, you have to recognize that you're talking about a long-term futures price. You're not talking about today's price. Drilling decisions aren't made on price of crude or natural gas today. They're made on the expectation of what it's going to be over the next 2 or 3 years. So those numbers in that chart have to be thought of as futures prices, not the price on any given day. So let's look at the gas industry for a second. This is showing you production again on the left, storage on the right. The gas industry is to me, a really interesting place, and to be fully disclosed, I've actually got a trade based on what I'm about to say. So I'm always accusing folks of talking their book, and I got to admit, I'm up here to some degree talking my book, but on the other hand, it is also what I fundamentally believe, and I was saying this long before I actually placed the trade. The graph on the left shows production, and you can see our production is back up what it was to the tune of about late 2015, and quite a bit below what it was last year. Over the last few months, we've been producing somewhere between a low side is about 69.8. On the high side, it's about 70.6 or 7. Right in that 70 to 70.5 BCF a day is what our production across the country is. And with that production, storage has ended up in the band of the 5-year average. And we're starting to increase. We had a slight increase the last week of February. I suspect this cold weather we're having in the Northeast will drop this down a little bit. But you can see we're relatively high inventory level in the gas space, particularly given where it is this year. Now, last summer, I gave a presentation like this, and I said that I thought the gas price would be $4 by the end of last year. And I believed that firmly, and even said it again in the first part of December. And if we'd actually had a winter, that might have happened, but we forgot to get winter this year. So as a result, our inventories are very high. Demand most of the entire winter was well below a seasonal average. This was looking like it was either the warmest or the second warmest winter on record. So this was definitely an anomaly, and as a result, storage inventories have held up. But if you've noticed over the last couple of days, they're starting to creep up because people are beginning to recognize that this won't work over the longer term. And I'll go through the next few slides to explain that statement. This is a demand curve that we put together, and you can see our total increase in natural gas demand. We projected a little bit over or a little bit under 11 BCF a day of growth between now and 2020. It's comprised of a little bit of ResCom growth. We actually think that winter will return somewheres in there and will save us if we have many winters like we've just had. That won't happen. Power demand obviously goes up. I'll come back to that in a second. Industrial demand, and then you've got increased LNG exports, about almost 3 BCF a day. That could be a little light. I think there's the potential you could see more of that. I think Robert's going to talk about that this afternoon. And then Mexican exports are going to increase a little bit too. The power is the big question mark here. And the power market's interesting because it's grown a lot since 2012, and everybody expects it will continue to grow. And I think it probably will. But you've got to recognize when you think about it that you have, there's two components to demand in the power market. One component is the component associated with structural change. If you retire coal plants, as we've done, replace them with natural gas-fired plants, that new capacity is firmly entrenched in the market. It can't trade off very easily against pretty much anything. The utilities need that capacity to run if they need the power. There's another component of the coal to gas dynamic, though, that is a trading-based component. It's based on a utility having the ability to consume either commodity, and it's the relative price of one versus the other that drives the decision. And in that case, there's some of that demand that as gas prices rise, as you'll see I think they will, that means the competition will be less robust, and you'll see more coal and less gas. Nobody really knows how to measure that, and we've got guys working pretty hard at trying to figure it out, but we're not there yet. But I think it's probably on the order of maybe 5 to 10% of the incremental difference is still able to be moved between the two camps. So if you take that demand curve and you look at it compared to what the forward curve says gas is going to be produced at, and again, you have to look at the forward curve for oil and the forward curve for gas. Those are shown on the was it? You're right. And then that red line is demand. You can see there's a big gap between the two. And that's why I say that gas prices can't stay where they are if we're going to sell as much gas as I suggested we are. Remember that chart assumes that we're only sending a little less than 3 BCF a day out as LNG. I think there's a lot of folks that would expect that market will be more robust. I think one of the questions that there is the same thing with some of the industrial demand, by the way. I think this statement applies to both, is how much demand for those products are there going to be globally? Because I look at the global economy and I don't see a particularly healthy world from an economic standpoint. And if the rest of the world isn't consuming material things, driving cars, driving diesel cars, trains, trucks, whatever, we're not going to consume the commodity. If you're not consuming the commodity, it's hard to get the prices higher than this. But if they don't get higher than this, this is what you've set up, a pretty tough natural gas market, which I think means the gas price has to go up a bunch. So what do I mean by that? Well, how do you define a bunch? Well, this is a graph that shows natural gas production, and we've got this in at, I put crude prices in at $50, just set it that way, just as a hypothetical to see what happens. And if you have a hypothetical $50 crude, and then you let gas prices move, you get the blue tranche there is how much gas is produced if the price of crude or of gas is $2.50. The green is $3.50, and the yellow is above $4. And you can see that you've got to be well into the $4, close to $4.50, to clear the market, particularly by the end of the decade. And how does that change if the crude price changes? Well, this shows us the same graph, or same demand, but we've increased the price of crude by $15, and that keeps the price of gas much lower. And those kind of frame the bookends, I think. I don't think it's likely to get to 65, but my hunch is it's going to be higher than 50 over the next 4 years. But, you know, I don't know that. So but anyway, this is the set of bookends that suggest it. But notice, in either case, you've got to have it over $4. And I think that's the thing that you need to walk away with is, as soon as demand picks up, either because it got hot, or this summer, or it gets cold next winter, or for some reason you see increased LNG consumption worldwide, all of a sudden the gas price is going to have to jump fairly significantly if we're going to clear the market. Now, why is it? Why are these two so related? Well, this is showing you, again, at that $3.50 gas point, how much crude could be produced with the fleet of rigs that were active last fall. It was $40. You see the blue, you add yellow, the green gets to 60, and at 70, you get the difference. The difference between 50 and 70 is about 3 BCF a day of gas. That's not including the gas produced in the Marcellus or any of the other dry gas, predominantly dry gas areas of the country. They're the ones that are making up the difference between the top and or the whatever oil price you got and the actual market. When you look at what's going on with rigs, the rig count, it's kind of startling, and it really shows how little the market really understands this dynamic. I mean, one of the ways you can see it, if you look at the forward curve, I didn't point this out, but if you look at the prices that are, the other day I bought some futures, or July futures contracts at $2.90. That's a ridiculous price. That's just, I mean, that is so low, it's preposterous. And a lot of it is that same, which again suggests the market doesn't really agree with my expectation of $3.50 to $4, but this is another indicator. If you look at the rig count, or 869 rigs, up 90% since last May. You'd think, wow, I'll bet you some of those are going into gas areas. Not so much. This is the distribution around the country. Most of them have gone into the what I would call predominantly dry or oil-prone areas. DJ or the Marcellus has gone up a couple percent, but not much. The big ones are the Eagle Ford and the offshore is the primary greater. I think these numbers are reversed actually. Looking at that, I'm not positive. Oh, it's through March, yeah. Okay, so I think it's you've seen a little bit in the Haynesville, a little bit in the Marcellus, and the Eagle Ford has a bigger bump than is shown there. That's not right. I don't know what is going on, but the Eagle Ford's an interesting one because the Eagle Ford has a lot of combined oil and gas. The gas price going up makes their $50 crude much more economic than it would be if gas prices are sub $3 or even $3.25. So again, that's the interchange between or interaction between the two commodities. So we'll show you what we're talking about in terms of our forecast, where we think things will go over the next few years. The top one there is our crude price. We actually had the crude price a couple dollars higher until about a month ago, and then we brought it down because we don't think it'll average that high this year. I think 52 might be a pretty good average for the course of the year. On the gas prices, you can see we dropped it quite a bit, and that's really the impact of last winter. I think it'll be very hard, given it's so late that it's going up, to see an average for the year be over $4. I think it's entirely likely, though, that you'll see some prices well over $4 between now and next fall, and by next winter, unless we've had a very, very mild summer, we're going to have prices considerably higher than that, or in order to clear the market. But notice it goes down over time. The gas price, and why does that happen? Well, as the gas price goes up, you increase drilling. Some of the drilling happens in the gas-oriented areas. Some of the drilling happens in places like the Eagle Ford, the oil areas. If the oil price goes up, as we suggest it will, that's going to put more impetus to explore in the oil-prone areas. You'll get more associated gas. As you get more associated gas, that combined with the increase in the short term of dry gas, and you start to build a surplus again, and you drive prices back down. This is where the two regulate each other in a sense, and it's going to be very difficult, I think, to see long-term gas prices staying above $4. I think it's going to fluctuate in that $3.50 to $4. It all depends on how strong global demand is. When you look at what we're expecting in terms of production, I've got this shows you we think that crude production is likely to move up close to, with $52 crude, we should be up another 353,000 barrels over the course of the year. By next year, it's another chunk on top of that, and we start building up a pretty good head of steam on the crude side in terms of incremental production. What's interesting about this is I was at a meeting earlier this week in Houston, and the company pays a lot of attention to production in the Permian and Eagle Ford areas. And they were telling me that their discussions with producers and their models are suggesting that both of those basins on their own will be producing over 100,000 barrels a day more than they did last year by the end of this year. So think about that. These two basins in the United States are producing 30% more than the aggregate cutback of all of the rest of the world, and about 25% of the best case projected growth of the world. You know, and that's what's shown in these numbers to some degree. It just takes a little bit longer for it to get. We don't have it growing that quickly, but they're saying that could be the case by next year. So the U.S. can produce a crazy amount of crude, particularly when you think about it was only 5 years ago we were talking about not growing crude. People didn't even think about drilling for crude in the country, and yet here we are in this kind of a world. When you look at, one other point here, this is important, is the Eagle Ford and Permian are the big dogs in this debate, obviously. And those are the two areas that are growing. And it's important to recognize that the implications, one of the implications of that is a lot of that crude is going to have to go to the Gulf or go somewhere for export. We can't, unless we're not consuming a lot of Canadian and our refineries go through some major changes from a structural standpoint, we can't produce or we can't consume that much light crude in the country without a fairly significant discount on the condensate side. So the better market will be to ship that crude overseas. That's a lot of infrastructure that's going to have to get established in the Gulf in order to get that crude out. It's not going to be an easy thing to do, and this will put some pressure on our refinery structure, our refineries. When you look at natural gas is set to grow, although a little bit more conservatively. We're looking at a little over 80 BCF a day by 2020, which is within a BCF a day of what we think the market will be. So we think that makes sense, but you've got to have some pretty strong prices. I've got the asterisks on this, on the 350, because I think it's important to recognize that's an average number for the year. I think you're going to see some significantly higher prices along the way this year. By next year, I wouldn't be surprised to see those start to come down a little bit and average out 350. But you're going to end up with a lot more gas. You're going to see a lot more out of the Utica and the Marcellus. It's interesting because you've got part of the development in the Marcellus and Utica has been retarded because of pipeline capacity. I think there's an ability to produce a whole lot more gas in the Marcellus, particularly the northern parts of Pennsylvania, and I think you'll see it now that Rover and Atlantic Sunrise, some of those pipelines are actually look like they're going to get through their permit or get through their regulatory hurdles and become real. So I think you're going to see this distribution probably skewed even more to the Utica and Marcellus. So with that, abundance has brought a completely new game. And it's going to affect both oil and gas. I think OPEC has done something with their proposed restrictions to kind of improve the price in the short term, but it's already not working very well. And I think it's probably not going to work very well until demand is reduced. Demand is the key. If you don't get demand down, not only here, or you don't get demand up, not only here but around the world, you're going to have a very hard time balancing the market at anything like the current price. If they implement their plan long enough, they could be successful. But if they are, and the longer it persists, the likelihood is that it's going to come down again without demand, and its volatility is the key. Meanwhile, the gas market in the U.S. is kind of setting up for some significant issues. We expect low fours this year, maybe 450 by the end of the year. If it's a hot summer, I think that's a high likelihood. If it's a hot summer, we're likely to see over 4 by July or first part of August. But they're not going to last because the higher prices coupled with what will ultimately be $55 plus crude will drive enough extra incremental natural gas production into the market so that prices will come back down. And the NIMBYism kinds of things, the pipeline construction, we didn't go into it here, but I'm running low on time here. I think that has a big factor. So with that, I've got 2 or 3 minutes left. We can answer questions. Somebody's got to have a question. Robert. Okay, thank you. We're importing sour crude, but more importantly, we're importing heavy crude. You know, and if you look at the U.S. refinery structure, there's about 17.5 million barrels a day of capacity in the country. There's about 1.5 of that that goes, that is used by refineries that are owned by Saudi Arabia, other foreign countries, and that crude is typically brought to the United States from outside of the U.S. There's about 3.5 million barrels a day of Canadian crude that comes into the system, and that generally is sub 30-degree crude. It's heavy. And so that leaves about 12.5 million barrels a day of open to U.S. supply capacity in the U.S. At 12.5 million barrels, and remember that graph I showed you was up over 14. At 12.5 million barrels a day, in order to fit more U.S. crude into it, you have to start discounting condensate. If a typical refinery, we've got a model that optimizes capacity at each of the refineries and then aggregates them all up and optimizes the country. And what you can see is that these refineries are designed to run heavy crude. That's what a lot of the reconstruction activities in the last half of the 25 to 2010 were all about. A lot of refineries sunk billions of dollars into restructuring their refineries so that they could use the Canadian and Venezuelan, actually, crudes that are very heavy. Well, what happened? They got it done just in time to start producing a whole bunch more light crude here in the U.S. If they're trying to produce an equal level of profit out of that refinery with a lot of condensate or very light crudes, they have to discount the purchase price of the crude in order to get the profit to work. It just doesn't work any other way. So as a result, if we're going to produce 14 million barrels a day of crude, we're going to have to export probably 2 to 3 of that in order to be able to keep our prices up. Otherwise, we're going to have to discount. You'll see a lot of discounts. And if you remember back in the 2012-13 timeframe, you were seeing light crudes in the Permian that were carrying a $5, $6 a barrel discount. Same thing up in the Rockies, up in the Bakken area too. So I mean, the quality of the crude is important, and how it fits into the refinery run situation is key. No, I think that's kind of what's known as a screw up. I think it's 50-50. It's the 50-55 is the, if you're talking about what we think it will be longer term. Yeah. Yeah, no, I think it's probably 65 is a very high side, and probably it's somewhere between 60 and 50 for most of the balance of this decade. I think it's pretty hard to see that. And it all is a function, in my mind, it's all a function of demand. If you don't see, China just announced the 6.5% GDP. That means it'll probably be somewhere between 5 and 5.5. At that kind of a GDP rate, they're not going to consume a whole lot more oil. I've seen a couple of banks have rules of thumb. The globe has to have a 3.5% GDP to get 1 million barrels of incremental demand. I don't think there's a chance in hell we're going to have a 3.5 GDP rate around the world this year. Just not going to happen. What are your opinions about the cracker plants? I couldn't hear the cracker plants you're talking about. Uh-huh. I think you're going to, I would bet that they have to, I think you'll see, I'm working on a project with a client where we're looking at bringing liquids out of the Permian down and building another cracker and putting it down there. I think that you're going to see more of those. I think you have to. The U.S. has just too big a competitive advantage not to. I would expect you'll see more of them in the Virginia area, West Virginia area. That'll build up as to get a critical mass. That's a great question. No, it's a great question. And it's, you know, the whole Rockies, you know, you can expand it to the whole Rockies. I think it's a tough area because you know, you're behind the 8 ball from a transportation standpoint. You know, you've got probably the most expensive transportation around. If you look at DAPL's going to do a lot to get some of that crude into the Midwest market so the producers can get a higher net back on it, and that's a good thing. But there will still be a discount to the Williston supply, and so I think it takes a good 55 or a good 53, 4, 5 expected price to get drilling to really jump up there, I think. And then the problem is for the Rockies is the gas price. You know, yes, it's the gas price is more national and basis differentials are not what they used to be, but the problem is the Rockies now, because of everything being produced out here, is being pushed out of the Midwest markets, and so they're relegated to the West Coast markets, and that, you know, they're just not growing that fast, and there's a whole lot of competition because all that Permian supply that's coming online, that gas is going to have to go somewhere, and it historically is, when it's been too much, it goes west, and so there's a lot of competition for the Rockies gas producer, and I think it's problematic. Anything else? Okay, thank you.